America has the most to lose, right? And I just did a presentation on this, politics and populism. So, and I went through the history of empires, and it's really pretty amazing. They all rise for the same reason, power. They all stall for the same reason, politics. And then they fall for the same reason, populism. As much as I believe in Bitcoin being better money, I actually don't think anytime soon the nation states are going to abdicate their right to control their particular money.
A few weeks ago, Federal Reserve Chair Jerome Powell spoke before the House Financial Services Committee, reaffirming the Fed's position on the economy in the face of January's surprise spike in inflation and encouraging employment statistics. Powell stated, "We want to see a little bit more data so that we can become confident," underscoring the need for additional information to support the Fed's decision-making process. Powell made reference to possible rate decreases later in the year, even though he acknowledged the strength of the economy and a thriving labor market. But even as we wait for these kinds of moves, well-known investor and Morgan Creek Capital Management founder Mark Yusko provides a different viewpoint. In a recent interview with Anthony Pompliano, Yusko expressed concerns over the potential repercussions of rate cuts, foreseeing significant economic challenges for the United States. Yusko provided a perceptive forecast for the U.S. economy in 2024 and beyond. He covered a wide range of topics, such as rate cuts, the dynamics of inflation, and the revolutionary impact of technology innovations on the world economy. Yusko explained the complex interactions between these elements and their consequences for investors and regulators alike, drawing on his vast experience and knowledge. Yusko's research offers an effective counter-argument as the discussion over the Fed's monetary policy heats up, advising cautiousness and careful thought before taking any significant actions. We're going to reveal some interesting insights from Yusko's interview with Pompliano today, so come along as we examine the complex forces influencing both the U.S. economy and the larger global financial scene coming ahead.
I talk about this, the pollution of the most recent period, right? It's like all the data is polluted, right? The data on, price to earnings for the stock market, it's all too high. And people look, well, the last 10 years, and I go, but the last 10 years have been above average of the last 100 years. So it's just the data is polluted. And the same thing's true here of rate cuts or interest rate levels. Right? People seem to think that zero was a normal interest rate. We've had 247 years as a republic. We've had two very short periods of time where they pushed interest rates to zero, right after the 1930s debacle with the Great Depression, and then again here after the global financial crisis. That's not normal. 4%, kind of where the 10-year is right now, is normal. So this idea that somehow we need to go back to 2% rates just doesn't make any sense to me. You asked a question that I didn't answer, right? Is inflation going to come roaring back like the 80s? I don't think so. I mean, we've all seen the chart, right? The big spike, the drop, and then the second spike in the 70s. Part of that spike was a false spike in the sense that they were double counting. Volcker's Fed was double counting interest rates, and that they were counting mortgages and interest rates. And there was this weird thing. And Mike Green has talked all about this in the past. So that was the big problem there. So I just don't see that happening. And all of this deflationary pressure that you talk about comes from technological evolution. And technology is not growing linear. Jameson Lopp put out the thing this morning, which is, the Kurzweil chart. And it looks like this linear increase in technology and advancing in compute, but it's because it's on a log scale. And, it's one of the things that drives me crazy all the time. Everybody shows these hockey stick charts. Well, any long-term chart has to be log scale. You can't look at a long-term chart and you see like the interest payments and they look all of a sudden like, well, that's because you're looking at 50 years. You need a log scale because going from 10 to 20 is worse than going from 20 to 30. So all of that says, does Powell look at what's called hedonic price adjustments? Meaning if technology runs faster, or like your washing machine gets your clothes whiter, that, is deflationary in theory. I'm not quite sure why that is, but, so my computer processes faster. I don't type any faster. I mean, I still type at the same rate. So I know that there's some productivity enhancement in having more compute, but for certain productivity, I don't really see it. But I do think on the job front, on your question on AI, as people get displaced, as human beings get displaced, that certainly will change the dynamic of inflationary pressures. My flip side, though, of that, my caution is everyone says that every new technological innovation is going to destroy jobs. It's true, right? I mean, machines took jobs away from people who were, plowing the fields or assembling things in factories. But here's the thing: we've destroyed millions and millions and millions of jobs through technology. But today, there are more jobs in the world than any time in human history. Right? That's just a fact. So we'll create new jobs, and that will reverse some of that deflationary pressure.
But that's not all. Additionally, Mark Yusko offers his thoughts on the possible shift of economies, including the US, to a Bitcoin standard. Even if he thinks Bitcoin is a better form of money, he thinks it's unlikely that nation-states would give up control of their national currencies in favor of Bitcoin. Using his wealth of expertise and experience, Yusko talks about the institutional opposition and real-world obstacles that prevent Bitcoin from becoming the accepted global currency quickly. Furthermore, Yusko emphasizes the significance of gradual adoption and thoughtful portfolio allocation towards Bitcoin, arguing for a cautious stance in the face of changing financial conditions. In order to become financially resilient in the face of uncertainty, he highlights the need of diversification and the necessity of getting off zero in terms of Bitcoin exposure. Come along as we work our way through Yusko's thorough analysis, discussing the challenges of moving to a Bitcoin standard and the tactical issues investors should be aware of at this pivotal period of the evolution of money.
So when do we become on a Bitcoin standard? I think it's actually a long time away. And the reason is as much as I believe in Bitcoin being better money, I actually don't think anytime soon the nation states are going to abdicate their right to control their particular money, right? And look, I don't know if you've ever had Murray Stahl on the podcast. You should have him on. And he makes us look bearish. Like, how is that even possible, right? But he makes us look bearish because I talk about this all the time. To me, Bitcoin displacing gold as the base layer of money, easy. $6 trillion market cap. That's like you can bank on that. That's totally easy. The next step, which is where the good money crowds out all the other money, and we start talking about, to your point, not Bitcoin in dollars or Bitcoin in yen or Bitcoin in euros, but euros in Bitcoin or dollars in Bitcoin, because it is the standard. There's a book called the Bitcoin Standard, right? But that's inverse to Gresham's law. Gresham's law says the opposite. That bad money always crowds out good, right? Gold is good money, but other paper money always crowds that out. People want to use the bad money because I don't even understand the exact reason for Gresham's law, but it's a law, right? And if you look at history, that's what happens: is people flock to the worst currency at the worst possible time, and that's why you get the hyperinflations eventually. Zimbabwe and Argentina and Turkey. So what Murray says is we're going to get a reverse Gresham's law, and this good money, this Bitcoin, is going to eat all global currency, which today is about 87 trillion. Oh, just round it to 90 or round it to 100, doesn't even really matter. Trillion here, trillion there, pretty soon you're talking real money. That one's harder for me because I think we've seen how hard people are fighting just on the little stuff as Bitcoin starts to siphon money out of the banks. Right? We all experienced that with, we saw the lenders pop up and people took their fiat, converted it to stable coins or Bitcoin, and got paid interest in a zero interest rate world, which was unnatural. And the banks were like, 10 billion, who cares? 100 billion? Now we got a freaking problem. Now we're going to make it, illegal or unethical and we're going to put people in jail. And like, there's still people in jail for writing code. It just boggles my mind. So I think it's a long-winded way of saying, I think they're going to fight it really hard for a long time. And the smartest people are going to get that, and they're going to increase their exposure. I mean, look, you and I have been talking about this for a long time. Get off zero, right? Zero has always been the wrong number. How big that number is in your portfolio, that's a debate.
In his remarks, Mark Yusko expresses his belief in the revolutionary potential of Bitcoin while also recognizing the significant obstacles that need to be overcome before it can be widely adopted. He says that because nation-states are reluctant to give up authority over their monetary systems, the move to a Bitcoin standard is probably going to take some time. Yusko brings up Gresham's law, which says that weaker currencies eventually force out stronger ones. This idea, he suggests, should be reversed, claiming that Bitcoin, as good money, may replace conventional fiat currencies, which he labels as bad money. This viewpoint is consistent with the prediction made by economist Murray Stahl that Bitcoin would eventually replace fiat money as the standard currency of the world. Yusko acknowledges that despite this positive perspective, conventional financial institutions and regulatory organizations continue to oppose Bitcoin. He uses instances of banks trying to impose restrictions on Bitcoin's use and punish participants in its ecosystem as a way to demonstrate this opposition in response to the cryptocurrency's disruptive potential. Yusko concludes by highlighting the need of progressively boosting exposure to Bitcoin in investing portfolios and drawing attention to the continuing discussion over the ideal allocation. He suggests that even if there could be a lot of resistance to the shift to a Bitcoin standard, visionary people and organizations will see its potential and deliberately step up their engagement in the cryptocurrency industry.